Hey everyone, so if you're thinking of opening a HELOC, it's probably because it seems like a simple way to access your equity, especially if you're planning something big like a renovation or helping with college tuition. But the part that usually gets overlooked is how the interest works, because unlike a regular loan, the rate on a HELOC isn't locked in. It can go up at any point without warning. And when it does, your monthly payment goes up right along with it, even if your balance hasn't changed at all. See, that's where a lot of people get caught off guard, because what started out feeling manageable can get expensive really quickly. And that cost can keep rising long after you spent the money. So in this video, we'll take a good look at how HELOC interest really works and what you're really signing up for. Now, early on, a HELOC can actually feel pretty manageable. During what's called the draw period, which usually lasts between 5 and 10 years, your minimum payment only covers the interest on whatever amount you borrowed so far. So if you take out, say, I don't know, 40K for a kitchen remodel, you're not paying back any of that 40K quite yet. It's just the interest. And depending on your rate, that might only come out to a couple $100 a month. But that's exactly where the problem starts, because once that draw period ends, your HELOC flips into the repayment phase. And now you're responsible for paying down both the principal and the interest, usually over a 20-year term. So even if you haven't touched the account in years, your monthly costs can suddenly double or even triple overnight. And if your interest rate has gone up in the meantime, that jump hits even harder. You're now carrying the same balance, but with a much, much higher cost. And you have no flexibility left in how it's repaid, like at all. That shift is what lenders call amortization, but for homeowners, it just feels like a gut punch that you don't see coming. Now, if you're thinking about using a HELOC short term, like for a renovation or a bridge between buying and selling, it's worth checking out how early repayment works, because while most lenders will allow it, some of them can make it really expensive. They're called prepayment penalties, and they usually show up if you close the account too soon. That could mean selling your home, refinancing into something better, or just deciding you don't need the line of credit anymore. And the penalty itself is often a flat fee, usually a few $100s, which then gets added onto your closing costs. It's not based on your balance or your payment history. It's just something that a lender will include in the fine print to make early exits more difficult. And the tricky part is, it might not even come up unless you're way deep in the process with your agent or lender. So even if you're trying to be smart with your timing, there's a chance you'll end up paying more just to walk away clean. Now, if this all sounds like a lot of stress just to get your own equity out, you're not wrong. And that's why Point offers something completely different. It's called a home equity investment. Now, this isn't a loan, which means there is no interest, no monthly payments, no debt on your credit report. Basically, here's how it works. Point will give you a lump sum of cash, up to $600,000, depending on your home, in exchange for a share of its future value. You get the money now, and then you settle up later when you either sell, refinance, or hit the end of the term. And since there are no monthly payments, you don't have to worry about rate hikes, budget swings, or the cost of borrowing getting out ahead of your income. It also doesn't rely on perfect credit. You can still qualify with a score as low as 500, and there's no income requirement to meet either. Now, it's not for every situation, and we'll take a good look at how all this works in a sec, but if you're looking for flexibility without locking yourself into long-term payments, it is one of the few options that can give you some room to breathe. Okay, so let's say you took $75,000 from Point 5 years ago. Now you're selling your home. That is when the agreement gets settled. There's no interest, no loan to pay off, just that original $75K plus a share of your home's future appreciation. And that share is based on how much your home has gone up since the investment was made. So if it was valued at, say, $600,000 then, and is worth $750 now, Point will take a percentage of that $150,000 gain. Now, the exact share is going to depend on your agreement, but it is fixed from the start. There's no surprises down the line. What's cool is if your home hasn't appreciated or even goes down in value, Point shares in that loss as well. You could end up paying back less than you got up front. There's no penalty at all if you decide to sell things early. And there's no requirements for where the money goes. So maybe you're updating the kitchen, or your kid wants to go to school out of state. Doesn't matter, you can do whatever you want with it. Now, if you're not looking for an HEI, you'd rather go with a loan, what you really just don't want is one that looks affordable right now, but flips later and absolutely wrecks your budget. And that's where Point's HELOC comes in. It works like a traditional line of credit, but it's built to avoid that huge spike that happens when the draw period ends. Here, there's no delayed principal or big jump on the horizon. You start paying down the balance from day one. So your monthly cost stays more predictable, and that consistency can make a huge difference if you're managing a budget or working on a timeline. And another plus, there's no penalty for early payoff on this one either. So if you finish your project ahead of schedule or sell your home midterm, you're not stuck paying a bunch of extra fees just to close out. You can still borrow up to $750,000 depending on your equity, but what makes this different isn't how much you can borrow, it's that you don't have to plan your life around a payment spike that will show up years later. What you see is what you pay. So here's the bottom line. A HELOC can absolutely give you access to your equity, but unless you're paying very close attention to how the interest works, it can also trap you in a repayment structure that will absolutely crush you. Because once that rate changes or the draw period ends, you're covering the difference. That's why the way a loan is built matters just as much as the rate you start with. And what Point offers, whether it's a home equity investment with no monthly payments or a HELOC that won't bite you a decade from now, they're all tools designed to give you more control. And if you want to explore Point's options, I'll leave an affiliate link down in the description and in the comments. It doesn't cost you a thing extra, really, but we might earn a small commission on it. If you do, it really does help out the channel. Plus, sometimes there are special offers there that you won't see on their main site. So feel free to check that out if you're interested. Also, if you'd like to work with us or sponsor a future video, just reach out using the email in the description below. And hey, if you found this helpful, feel free to give it a thumbs up or subscribe if you'd like to see more content like this. If you got any questions at all, seriously, drop those down in the comments. This stuff can get complicated, I know, so I try to answer as many as I can. Thank you so much for watching, and I will see you in the next one.